Good afternoon, everyone. It's Monday, the 13th of January. And my name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. And welcome to another edition of Monday Market Picks. Now, most regional and global markets are feeling the pinch after a very strong US job report and also oil gapping up after some US sanctions. Only the US and Singapore is actually above their 200 DMA at this point in terms of major markets. But when you talk about regional markets in Singapore and Malaysia, the big news is the Johor Singapore Special Economic Zone that was announced last week. Is this a real deal? I'm going to explain. Also, we revisit the REITs after a year of being unloved and underowned. Krishna thinks that things are about to change, and we'll have him on the show to discuss why. And then we'll also have Husseini, who says that continue to be overweight on the internet sector in ASEAN, even after a blockbuster performance last year. We'll have him on the show to discuss why as well. And last but not least, we have our chart guy, Amirul, also joining us to talk about two trading buy ideas as well. Now, let's start with Singapore as well as Malaysia. Last week, the governments of Singapore and Malaysia signed an MOU on the Johor Singapore Special Economic Zone. Jointly, they're targeting 100 projects in 10 years with sectors like aerospace, electrical and electronics, chemicals, medical devices, and pharma as priority sectors, together with support for a wide selection of other sectors from digital economy to manufacturing. Now, Malaysia plans to set up a fund to support infrastructure, and Singapore's plans to actually design funding to help Singaporean companies go and set up in the special economic zone, as well as to enable MNCs to have twinning programs with the special economic zone as well. There are also initiatives to unclog the border and also enhance visas for living and working in the SEZ. Now, a lot of people have asked me what's different this time around with this SEZ versus the past iterations, including the Iskandar program a few years back. I think the biggest difference is the government to government commitment on both sides. Last time around, it was mostly a Malaysia effort. This time, Singapore is also putting money and policy behind the special economic zone. There's also a business case for both sides. On Singapore, there is a business case to allow some of the pressure from doing business domestically to be released and shifted to Johor. And for Johor, there's a business case in terms of driving economic growth as well as job creation. So we think for Singapore, this will support equities under four themes. First is lowering operating costs and also supporting lowering labor shortages. And second is stimulating North to Southeast Asia supply chain shifts. As we know, we think the trade war between US and China is most likely to intensify with Trump becoming president in a couple of weeks' time. Third is Singapore's ambitions to fast-track net zero ambitions and to lower carbon emissions. And finally, expanding and investing in infrastructure and property investments in Johor. These will be largely positive for Singapore's companies. The banks will be one of the biggest beneficiaries as they have regionally integrated businesses and they have a very entrenched position already in Malaysia. They have also been investing a lot in capturing these supply chain moves from North Asia to Singapore. Telecoms would also benefit with the data center theme and increased needs for cross-border connectivity between Singapore and Johor. Increasing demand for green energy and Singapore's own ambitions to import electricity, green electricity, should benefit the industrial sector. And also the tech manufacturing sector might actually benefit as well, because these tax benefits might actually encourage them to set up more manufacturing capacity in this region. Another beneficiary will be the gaming sector. If the border becomes unclogged, we may actually see more mass market gamers coming into Singapore for gaming. And lastly, property developers and REITs may actually have mixed blessings. On one hand, they may actually get more options to participate in the infrastructure development in Johor. But on the other hand, they may actually experience some business leakage, particularly in terms of office as well as retail going into Johor as well. But we think this is something that will recalibrate over time as more higher value added industries take that space up in Singapore. Now, in terms of companies that will benefit, we think there will be many. But if I want to highlight a few key ones, the two banks which have Malaysian presence, so UOB and OCBC, Genting Singapore from a gaming angle, Singtel from a data center and cross-border telecom infrastructure angle, Sembcorp Industries from the alternative energy angle, and finally Franken from the manufacturing angle. On the Malaysia side, we think that the property sector will be the earliest and the most primary beneficiaries. We've already seen a lot of those names running, but we think that EcoWorld, Itmax, YTL Power, Dialogue, Al Salam, REIT, and AME Elite should be some of the stocks that will benefit. Also, plantation companies. So names like Sime Darby Guthrie, KLK Kepong, Genting Plantation will also benefit because they've got fairly large land bank in Johor. So instead of planting palm oil, some of them might actually end up planting data centers and high-tech manufacturing. So that's another area that will benefit from this special economic zone. So quite a lot of excitement, a lot of moving pieces. We think both sides will be in a hurry to come up with the incentives and make things clear as fast as possible. So I think this is a theme that investors should be invested in as we progress through this year. And we will certainly have a lot more in terms of coverage on this as we go forward. Now, with that, let's turn our attention to the REITs and bring Krishna on the line. Krishna, welcome to the show. And so, Krishna, the REITs have been a big underperformer last year, and investors have been fairly underweight this sector. Despite this, you're actually keeping your overweight or positive view on the sector. Why?
Yeah, thank you, Tilan. Thank you for having me. It's good to to talk to the investors second week in a row. So yes, we are still staying positive despite the underperformance last year, and the three reasons for that. First is we hold the view that of the continued rate cuts, and we think the Sing dollar 10-year bond yield won't be behaving like what we are seeing in the US dollar. We are expecting it to stay capped for rest of the year. So this should support the overall distribution. The lower interest rates will support the DPU, and because the yields will be capped, the valuation downside is also limited for the REITs. Second, the overall yield spreads that we are seeing for the sector is reasonable compared to the historical averages. So the yield spreads right now are trading at about +1 standard deviation versus history. And finally, the third point about the underweight positioning. So this, in my view, the underweight positioning basically suggests that if there is any disappointment from the REITs on the fundamental side of things, because of the underweight positioning, the risk of a fallout on the share price standpoint is relatively limited. So I think because of these three reasons, we continue to have our positive stance for the sector.
Got it. So within that, what are your subsector positions and what's driving your preference?
Yeah, so we are going with the order preference among the subsectors for us is first is commercial, followed by industrial, and then hospitality. So commercial, first I will take up with the retail. So retail side, the retail sales overall has flatlined. We know that, but increasingly what we are seeing is inflation is coming down. Interest rates are also continued to be cut, so that will be a beneficiary. The consumer spending will be a beneficiary from that. Plus, we expect MAS to ease on the appreciation stance for the Sing dollar, so that should also bring in the tourist arrivals as well as some of the overseas leakage that we have seen. So net, that should support the overall retail spending. On the office side, the sector has been underowned for quite some time. And also we are seeing probably on the last mile of the supply pressure in Singapore. So if the second half economic growth picks up, then that sector should benefit from a higher occupancy. So that kind of underpins our preference for the commercial sector. For the industrial side, the sector has done quite well for quite some time now. Over the last 3 years, we have seen rents and prices going up, but we are seeing that growth rate to slow down. Coupled with the fact that we are seeing supply coming up after this good sort of streak of rents and prices going up, we will have to digest that supply. So we are turning a bit more neutral on the industrial side of things. Finally, our least preferred sector is the hotels, and that's primarily because of the relatively tough higher base that we will see it in the first half. Because last year we had quite a bit of events in Singapore, which boosted the tourist arrivals for the Singapore. So this year we will not have that effect, and therefore we have to rely on the second half as to how the growth comes up, both from the China tourist as well as on the corporate demand side of things. So we are starting the year with an underweight on the hotel side of things.
Got it. And what are your top stock picks?
Yeah, so on the large cap side of things, we are maintaining our preference for CICT CLAR and the Mapletree and Mapletree Industrial Trust. Then on the small and mid cap side of things, we like Capital and Ascot and CDL Hospitality Trust on the hotel side of things, and the high yielders, Lendlease, Global Commercial REIT, as well as OUE REIT. So it's about, we cover about 20 names, and we are going with this preferred names, about 7-8 names spanning across both quality and value.
Got it. Okay, I just want to change tack a little bit. Now, you've initiated on Parkway Life REIT with a buy. Now, before we go into the investment view, can you give us a little bit of a background on Parkway Life?
Sure. So this is it's the largest healthcare REIT in Asia. It was listed in 2007. Its presence is primarily in 3 countries. One is Singapore, then Japan, and it has recently established footprint in France. In terms of the assets that they own, they own hospitals in Singapore, and they also own nursing homes in Japan. And then the third market recently that they acquired, France, they also are growing their footprint through nursing homes in France. So this is primarily a healthcare positioning that they have. In terms of their track record, they have grown their distribution in NAV over the last since they have IPO'd. And overall, the sector positioning remains quite favorable with an aging population and government support towards the nursing homes, etc.
Got it. And so, what's driving your buy call? Why are you bullish on this stock?
Yeah, 3 key reasons. So what I have mentioned before is the track record. So they have been able to grow their DPU and NAV almost an uninterrupted way for both of them since their IPO. And this excludes any sort of divestment gains that they have distributed over the years. That's the first point. The second point is in terms of their lease structures and the asset enhancements that they have already planned, there is a visible growth of the distribution within our forecast period. So we are forecasting about 7% DPU CAGR over the 3 years. And we think that this is quite a defensive one, that is investors will realize the DPU growth. And the final thing is in terms of their backing from the sponsor, which is an well-established name, as well as the favorable sector thematic that they are exposed to. So those are the three sort of main reasons why which underpins our buy rating on this name.
Got it. And very quickly, any downside risks that we should be aware of?
Yeah, so I think, as I mentioned, the valuation is a bit on tighter side, especially on the yield front. So I think there is much less room on any kind of disappointment on the DPU growth. That's point one. The point two is also the execution risk that comes up with with overseas geography. So they have recently expanded into France. So we need to look forward to any kind of execution risks there. And finally, in Japan, I think it's a bit more of a mature market, and there has been sort of episodes of where there has been bankruptcy in terms of the operators. So we need to look forward to how they manage that risk. So those will be the sort of three risks that we'll look forward to on the name.
Great. Thanks, Krishna. You can read his report in today's newsletter. Amirul, our chart guy, can't join us, but let me quickly run you through our key trading ideas. So his first trading idea is Yangzijiang Financial. He thinks that the recent correction from October 2024 high has ended after the price broke above the descending triangle pattern, and a new bullish move could unfold soon on this stock. He also has a trading buy on Frasers property. The stock has tested the current resistance line multiple times while maintaining its position above all key moving averages. He thinks that a breakout should lead to a bullish continuation from here. So do have a look at the more detailed write-up in his technical analysis in our newsletter today. Now let's turn to Hussaini, who's saying that ASEAN Internet had a very strong year in 2024, and he suggests that this trend will continue in 2025. Now, Hussaini, one of the key areas that you're highlighting is fintech reaching prime time. Can you elaborate?
Yeah, sure. Thanks, Thilan, and thanks for having me on the show. So, yes, we think fintech growth could stand out in 2025. And the drivers here are buy now, pay later, credit products, and digibank. So, as per industry forecast, overall lending space is expected to grow at a 23% CAGR over the next 7 years. We think internet names can outpace industry growth, mainly leveraging their ecosystem flywheel. So we expect revenues for the internet names to grow 32% year on year in 2025. And what is changing in this year, and to an extent it was the case in 2024 as well, is that the core business of the internet names are stabilizing after post-COVID normalization. So now they are pushing the related or tangential businesses such as fintech, leveraging their ecosystem. For 2025, we see Grab's fintech growth to get a boost from rollout of digibank services or digibank lending services in Indonesia and Malaysia, which are relatively underpenetrated. They as well, Grab as well acquired Chop, which will also help to expand the ecosystem to target new lenders. Long term, we see C Limited's digital financial services arm as well placed, given its e-commerce driven BNPL user growth. C Limited is also active in growing off-Shopee use cases, such as offering consumer credit to purchase handphones and electronic consumer electronics. C Limited as well discussed about offering two-wheeler and four-wheeler loans as well.
Got it, got it. And just very quickly, what are some of the other drivers that will drive the sector, and how does that kind of come into your topics?
So we think the 2024 tailwinds are mostly intact and likely to sustain into 2025. On the core business, which is e-commerce and on-demand services, we expect revenues to grow around 28% year-on-year and 16% year-on-year respectively. And this is despite higher base of last year. Underlying drivers include robust ASEAN macro outlook, rational competition, which in turn enables monetization opportunities. In fact, monetization opportunities are already visible as few of the e-commerce platforms have raised seller take rates by 0.3 to 3.3% in January this month. On the on-demand services as well, we see competition is highly stable, as well as some monetization opportunities in Singapore recently. There are also chatters of potential Grab and Gojek merger, which we see as positive for Grab. And finally, for Grab, quick commerce, which is grocery delivery as well as on-demand services, such as restaurant bookings, could provide an extra growth impetus.
Got it. So top picks are Grab, C, and GoTo.
So we have buy on all the three names, but C is our top pick, C Limited. We see monetization efforts are clearer, as seen with the recent seller take rate increases this month. One key catalyst which is brewing for C is the launch of a new game named Free. The game is in the soft launch phase for Android users in Argentina, but the initial feedback is really great, and upside from this is still not in our numbers.
Got it. Excellent. Thanks, Hussaini, for that. We are tight on time, so let's have a quick look at upcoming corporate announcements and macro announcements. We got Nordex coming out on the 17th of January. Obviously, the results season starts very quickly after that, with most of the REITs starting reporting, with Mapletree Industrial Trust first out the door on the 22nd of January. We got industrial production number out on the 24th of January. In terms of big events, please, I hope you have signed up for 2025 year ahead event and the very popular Feng Shui event on the 18th of January. That's going to be at the Singapore Center. If you haven't done so, you can scan this QR code to register right now. With that, thank you so much for your support, as always, for our show. Please do ask your clients and your contacts to dial in and join this show on a live basis, as well as you can catch this show on YouTube and on our app as well. Thank you so much for your support, and see you next week.